Good afternoon, everyone. Thank you for being here and for joining us for this live webinar where we'll be talking about investing with confidence in turbulent times. I think everyone here will agree that although uncertainty is normal, there are periods of time like the ones like this period that we're living today, where there's heightened geopolitical tensions, economic uncertainty, and the resulting investor emotions that our presenters and myself talk about all day or hear from investors all day, every day. And that's why we wanted to host this webinar and invite people to understand how investing with structure leads to confidence, even during times of uncertainty. And my name is Marcel Quiroga. I'm the founder and CEO of TQM Wealth Partners. I have the privilege and the honor of working with clients who understand the value of planning as a North Star for their investments and who value discipline and value proven strategies over speculation and over timing the market. That being said, in order to do that well, it takes a team. And I'm happy to have here people from dimensional funds as well as people from asset dedication. Both groups are groups that we work with very closely every day to be able to deliver results to our clients, which in our language, results mean helping people know that they can do what they need and want to do when they need to do it. With that being said, I'm going to hand it over to Cesar Magdaleno from Dimensional Fund Advisors. Thank you for being with us, Cesar, and he's going to kick us off.
Of course, thank you, Marcel. Everyone, my name's Cesar Magdaleno. I, as Marcel mentioned, work with Dimensional Fund Advisors. For those of you who may not be as familiar with us, we are an asset manager, meaning we manage the mutual funds and ETFs that are in many of your portfolios. We recently reached this year $1 trillion in assets under management milestone that we're very proud of. So it's something that's very exciting in our business. But today we'll be talking about markets, and I'm happy to give a little bit of context in what's happening today and how Dimensional thinks about it in managing the portfolios that are, again, inside many of your portfolios. So I think part of the conversation has to start with the reason people get uneasy about their portfolios. And part of that has to do with the exceptional good job that the US media does in making people freak out about their portfolios and particularly good headlines that are sometimes scary. So this slide I actually have a lot of fun making because it's super easy for me to make. I made it yesterday. I just Googled stock market, and there were no shortage of scary headlines that came up talking about maybe we're overly optimistic heading into next month. A stock correction might be coming. There are short sellers that are increasing their bets. I really like this one. The rally is back. The market is up, but risks are rising. So you might want to open this and have a little bit more reason to worry. So there's no shortage of this. And we see this all the time. And it's the reason that we get questions around our management, is the reason Marcel and TQM, probably all have jobs addressing this and helping you tune out a lot of this noise and navigate a lot of this uncertainty. And the one of the things that results in a lot of this uncertainty is that you'll have professional money managers trying to predict what's going to happen in anticipation and as a result of a lot of this activity and headlines. And one of the things that Dimensional points out is that it's very difficult for anybody to predict the future, as obvious as that might sound to all of you. And one of the studies that we do every year is we like to look at outlooks that were actually ended up being wrong. So these are actually from last year. In the gray boxes, you'll see some active calls or predictions that some of these top money managers that many of you probably recognize, JP Morgan, Deutsche Bank, Morgan Stanley. And I won't read them off, but they what actually happened in the blue is that these ended up being completely wrong predictions. I like particularly the one that's a good example is JP Morgan talking about their preference for U.S. equities over Eurozone and EM. And what ended up happening in 2025 is global markets ended up outperforming U.S. markets by a really, really wide margin. Actually, for the last year, emerging markets have been the top performing asset category. The dimensional indices looking at emerging markets show it being up almost 50% in the last year. And that's relative to maybe around 15 for the S&P. So these are the types of calls and predictions that we see a lot of forecasters make in these businesses. And just to emphasize how wrong they can typically be, another study we look at is, S&P prediction is a very, very common. And what this slide is showing is we looked at the 5 last years, so 2021 to 2025, and you can see the prediction year there on the x-axis. And what it's showing is the range of predictions that, again, these top analysts from these top financial institutions are making of where the S&P index return will be for that given year. The lowest prediction is those orange circles, all the way to the highest prediction in that turquoise circle. The green circle represents where the S&P actually ended up for any given year. And what you can see is that in most years, looking at the last 5, not only are they not accurate, but it actually ends up being outside of the range and that's what happened in 2021, 2022, and 2024. There is one lucky forecaster that seems to have gotten spot on in 2023, and then they went on in 2023 to get it completely wrong again. So this is just to speak to how difficult it is to make predictions, even though you might have a lot of the fundamental stories and headlines and predictions about what may be going on. So it's something that we like to review. Dimensional's approach is completely contrary to that. We have a strong heritage of leading academic research. In fact, our founder, David Booth, is somebody who studied under Eugene Fama, who, if any of you have had any exposure to financial literature and research and academia, is one of the godfathers of modern finance. Many actually just recognize him as the godfather of modern finance. And Eugene Fama, as well as several other Nobel laureates, are affiliated with Dimensional, advise on our funds, and a lot of their research helps build the principles that we use to manage our portfolios. And really, if I could summarize it, is all of the professional managers have access to this data. We all look at this data and use this research to make decisions in our portfolios. Where Dimensional stops is using that data to make a prediction. And we can look at a lot of the current topics to be able to explore some of this. Like, I know one topic that's coming up is inflation. And whether or not we can use inflation to predict what's going on in markets. And this is it's a busy slide, but basically what it's looking at the equity premium. And what the equity premium really is on this y-axis here is it's just showing, hey, what is the extra return you're getting for investing in stocks instead of doing something has a lot less risk or might be risk-free, like a treasury bond. Is there a positive return or is there a negative return? And this is looking at that return based on what the annual inflation is for any given year. And if these two variables were related at all, or they were correlated at all, what you would expect to see is a line, a diagonal line, either showing, hey, as inflation is higher, the market return might be lower, or as inflation goes down, then you might expect a higher return. What we actually see is a whole lot of nothing when you look for a pattern in this chart. And what that tells us as statisticians and as portfolio managers is that you cannot accurately use an inflation in any given year to predict what will happen in markets. And so even though you see a lot in the media of, hey, this particular inflation number is scary, it's going to play out in X or Y way in the market, that's not often a reliable way to actually guess what will happen in the market. And we expand this sort of study to a lot of different macroeconomic indicators that people look at. Another one that we look at more recently, because it's in a lot of headlines, is oil prices. So can we use in this left side here, we're looking at the start of year spot crude oil prices. It's what's in the news. It's what's about to hit $100 a barrel and what people are freaking out about. Can you use that start of year oil price to anticipate what's going to happen? In this case, we're looking at a different stock index. This is a global index. And basically, you see a lack of a pattern again. So again, pointing to the lack of reliability of being able to use this. We also use on this right side, we're looking at the year-over-year percentage change in oil prices. So if you see a dramatic increase in oil prices, is that something that points towards lower stock returns? On the other hand, if you see a dramatic drop, is that something that would point towards knowing what will happen in the stock market? And we don't really see that data. And what a lot of active managers do, and what they build their businesses around is, hey, this is not reliable data, but today is different because X, Y, Z. They'll go into different reasons about why this particular environment is pointing towards growth in the market, or maybe some contractions in some areas of the market. A lot of these slides look very similar, but I want to go through these to show the extent of how Dimensional talks about these and where we do research. This is a similar chart looking at interest rates. You'll see no pattern, and then no pattern based on any really area of the market and how you can use these to anticipate what's going on. Another big one is market volatility. If markets are volatile, it tends to create a sense of uneasiness in investors of, hey, you see a lot of activity in the market. Could this potentially mean that stocks are going to go down? And what we see in the data is, whether you're in this lower volatility fragment of the era versus a higher volatility, you have outcomes on both sides of the equity premium line, on the both sides of zero. So yes, as you would expect, sometimes the market does go down when there is a period of higher volatility. But as you would also expect, there's always a positive expected return in stocks, and at least that's when they get repriced, that's what you expect. And so you see those positive returns despite a volatile market. So I've talked about a lot about what typically doesn't work, and then I want to talk about what you can do and the variables that you can control and what Dimensional does. So I talked a lot about this bottom left box here, which is stock pickers and a lot of quantitative managers and what they do, which is they'll use the data to make predictions, to talk about what might happen in the environment. The other option is to just buy the market and buy all stocks, hold all stocks. And that's what this top left box of managers would do. These are traditional indices. You can think of like a Vanguard, for example, something that might just hold the whole market. Dimensional's approach is that you don't have to outguess the market to be able to actually beat it. And that's by holding the market, but controlling what you can control within it. And that's basically having a strong belief in what the markets do reward, which is discipline primarily. I really like this slide. What it does is it's going back to 1970, and it's looking at a lot of events similar to the headlines that are going on now. Right now, if you go on Google, you get a lot of Iran news. Yesterday, it was talking about how there are peace talks. Today, those peace talks seem to have really dissipated, and so now it's transitioning. But this is not something new for the U.S. or for really the world to face these kinds of uncertain events. And what we see is a very clear pattern. This is not this is totally opposite of all the charts I previously showed. What you see is a clear pattern of persistence and resilience in the market. Of, hey, even though you will have these maybe short-term swings based on a lot of these scary headlines, the market is resilient enough to reprice those securities, and we're resilient enough as a society to increase the value of the companies that we work in and that we invest in. And so you see a positive return over a long period of time, which aligns more with how you all invest. So that's Dimensional's belief. The other side of that, and this is just a quick note, particularly after geopolitical events, this is a recent study that we did. So we looked at like the beginning of the Gulf War, the Asian currency crisis in 97, the Iraq disarmament crisis. And what we've seen is even in the 1 year, so even on the short term, the 1 month, the 6 months to 1 year, you do see positive equity returns despite these major geopolitical events. That said, you do want to control what you can control within funds, and this is really Dimensional's edge. And so what we do is within specific funds, we break it down into variables we can control. Like we can control how we manage, for example, around taxes. We can control how we manage around trading. We can control what our exposure to the market looks like more than we can control what oil prices will do over the next year or two. And so our implementation is what makes us different. And looking at all of these, one easy example and one really great example that I like talking about is just in our exposure to different market opportunities. Dimensional market ETFs, which many of you are invested in, hold more companies than many of the more popular investment indices. I know the most famous one is obviously the S&P 500, which holds 500 names. Even if you expand and you go to these more global indices, they tend to hold closer to 10,000 names. Dimensional market ETFs actually hold more than 10,000 companies in our globally allocated portfolios. What this does is it gives you exposure to a global opportunity set and in a highly diversified way. And diversification is one of the primary ways that you can protect yourself against downturns in the market. So, for example, if there are, because of oil prices, if there is going to be challenges with companies that may have a high expenditure of oil, then you want diversification for, into companies that may not have as high of a dependence on oil prices. If there are challenges within the U.S., you want exposure to international developed markets. You want exposure to emerging markets. And that's what Dimensional considers. So it's mostly about controlling what you can control. That's our edge. What that results in is over time, Dimensional, we'll look at the top right figure here. Over the last 20 years, 78% of Dimensional equity and Dimensional funds have outperformed their benchmark, which are these indices. That's in comparison to 16% in the industry. And this is only, of course, the active managers in the industry. The more passive ones like a Vanguard will outperform 0% of the time because they're not looking to outperform. They just hold the entire market. So that's really what sets Dimensional apart. On the shorter term, you'll see, of course, we're a lot closer to the industry, 51 versus 40, because there's a lot more noise on the short term. But we, of course, manage portfolios for the long term because that's when you'll be invested. Last thing I'll say is none of this is to say that we don't expect uncertainty in the market, that we don't expect downturns in the market. That's something that we plan for and can combat through diversification and such. And this is just one slide maybe that I'll end with, just in terms of how well we can anticipate this. over the last 100 years of stock market data, what we've seen is a 10% decline in at least 56 of those years. So in the majority of years, you can anticipate there will be at least a 10% decline in the stock market at some point. Doesn't mean it'll end there, doesn't mean it won't recover, but at some point in most years, you can expect a 10% decline. And you can see the figures for 20 and 30% are also not an uncommon event, which I know my colleagues at Asset Dedication will touch a little bit more on and talk about how we can plan for that. But that's what I had, Marcel, on the market environment. I'm happy to take questions, or if we want to move on to Brent.
Thank you. Yes, just a reminder, there is a Q&A box at the top of the screen. If you'd like to submit any questions, we'll make sure they get answered. In the meantime, why don't we hand it over to Brent and then Steve? Thank you, Cesar.
First.
Thanks, Marcel. Thanks, Cesar. I'm Brent Burns. I'm one of the co-founders, along with Professor Huxley, who you'll hear from a little bit later. And he and I are going to talk a little bit about how we work with Marcel and how we partner with DFA. So I'll start with, we're not affiliated with DFA, and we use them, and we were talking about this yesterday about kind of how to frame it. And it's really that, Marcel is the architect. She does your financial plan. She puts the whole thing together, figures out where you're trying to go, what you're trying to do, when you're trying to do it, and then backs into how you're going to fund that. We are sort of like the general contractor, right? We pull the wires and we engineer the portfolio within the context of that financial plan based off of how she instructs us to time out things. And we use dimensional funds as our sort of raw materials, right? Those are our building materials. Those and individual bonds, right? That's kind of the two pieces as we put together a portfolio for you. And you'll see, I'm going to give you a little bit more background on how we do it. But let me start with this one. And is it coming through okay?
Yes.
Yes.
Great. So I'm going to answer the why dimensional, right? You heard why dimensional, but I'm going to say why we work with them. They don't pay us anything, right? We're not compensated by them. This is Eugene Fama, who Cesar mentioned earlier, is a longtime professor at the University of Chicago School of Business, and winner of the Nobel Prize in Economics. He's one of the several Nobel laureates that are affiliated with Dimensional. Why do we work with them? There's a couple of reasons. Let's see if I can make this click forward here. There we go. One is, we talked about that move away from commercial indexes. There's actually some real advantage to that. Mostly because, like for example, the S&P 500, when they make changes, they tell everyone 2 weeks in advance of the changes that they're going to make, which creates opportunity for hedge funds to go in and sort of game that system. They, as part of their trading discipline, they have a methodology for avoiding securities when their prospects are poor, right? They stay out of IPOs. They stay out of away from companies when they're dropped from an index, for example. One of the things that you'll hear us talk a little bit about, that Professor Huxley will kind of touch on it, is that we lean into small cap, which is small companies, value, which are kind of undervalued companies, and Dimensional has, when they slice up the market into those kinds of small cap or value or small cap value, they go smaller small cap, more value, which both of those premiums are reflected in the returns that as Cesar was showing. But we don't use them just because we like them or because they have fancy offices or whatever. They actually don't. Their offices are plenty nice, but what they do is put a lot of money back into their funds. So when there's all kinds of ways that with securities lending and other things that most mutual funds deliver out to their portfolio managers as a bonus, and and dimensional shovels that right back into the fund for as returns for the client. We test all this stuff, right? So we've tested the Vanguards and the other indexes that are out there. We stay away from active management because there's significant evidence that suggests that timing the market, and that was sort of reflected in one of Cesar's slides, that timing the market and stock picking end up costing you money. So we just want to take advantage of the returns that each of the asset classes has. And so how do we do that? Well, first off, we're talking about volatility here, right? We're talking about what happens when the media has to report, right? And so here's just a little cartoon, right? The pilot has indicated that we're going to experience a little turbulence. Please fasten your seatbelts. We're going to die. And then the person sitting next to him says he's a financial reporter. And when you think about it, financial reporters don't have that fiduciary responsibility that Marcel does to help you make the best financial decisions given your specific financial situation. Their job is to sell advertising. And in order to sell advertising, they have to have something interesting to talk about. If they viewed the markets in the way that I view them, it would be extremely boring. And so, because things are going to happen, right? Here's, the Dust Bowl. Here's the gas shortages in the 70s. Here's obviously, 9/11. Here's 2008. All kinds of things are going to happen, right? We don't have a great way of predicting most of these things. We think we might. It's like, oh, geez, I totally saw that coming. Did you in a way that was tradable? Probably not. So instead, let's look at how we might approach this in a different way. And that's really starts with that financial plan. Marcel mentioned that at the beginning. That's the most important part. What do you want to do with your money and when do you want to do it? How are you looking to support your family in retirement? What are the things that you would like to be able to do? Do you want to help your kids go through college? Do you want to pay for weddings? Do you want to have vacations? What are the things that are important to you? And then how are we going to fund them? So as part of that financial plan, we're going to project near-term cash flows. We're going to project them out as far as we can, but we know that the near-term ones we have a better sense of, right? Marcel will take that full comprehensive process, but we know that those longer-term, things will change. I've seen the bumper sticker, so I know that it's true. Stuff happens. But we can predict those near-term cash flows pretty well. And then at asset dedication, what we do is we take that input from Marcel, and she tells us how much and when, and we build out a portfolio of individual bonds on the front end. And that's an important piece. So as part of your overall investment strategy, really what we're using the bonds for is, yes, they're an investment, but even more so because we're using individual bonds, we can use them as a risk management strategy. And so, yes, we dampen volatility, but what we can do even more so is generate predictability in the cash flows, because the bonds are like a loan, right? They tell you how much they're going to pay you and when they're going to pay you back. So you give them $1,000, they pay you, $50 a year for 5 years, and then they give you your $1,000 back. So we use that as a tool to manage the stock market volatility. And so what we're looking at here is the S&P 500. This is since 1928 all the way through 2025. And this is at 1 year, rolling 2 year, 3 year, 4 year, all the way out to 25-year periods. And we call this the funnel chart. The green line across the top is the best that it ever did. We don't care about that. That's great if we get that, fantastic. What we have to worry about is the red line across the bottom. That's the worst case market returns, right? So that's what has a big impact on our portfolios. We know those are coming. We don't have a great way of predicting them specifically, but what we can do is protect against them. And then the yellow line is the average, and we're hoping to if we can get the average, we're doing great, right? But what we want to do is ultimately let the markets do what they do best, which is the bond market generates predictable cash flows, and the stock market generates long-term returns, but not without the short-term risk of seriously declining markets. So what we want to do is shift the time horizon out, right? So that's what we do with those bonds. those bonds protect us against that early like gray box. And then what we're trying to do is manage somewhere between those two red bars, right? Somewhere between 7 and 10 years. And with that, what we're hoping to be able to do is dampen out that volatility, ride through those bad markets, and let the stock market get back to what it does best, which is grow over time. So it kind of looks like this, right? Just in terms of the structure of your portfolio. So you guys are familiar with this, but I just want to sort of give you that framework. If we have money that we need, and this we'll call it year zero, like right now, we've got that in our checkbook, right? It's in our checking account. It's in our account so that we can access it, immediately if we need it, and that's to cover our mortgage and any expenses that we have. The money that we need next year is sitting in that bucket filled with bonds that mature next year. And oh, by the way, there's 8 years or 10. There's nothing magic about 8. Some of you might have 8, some of you might have 6, some of you might have 10. But we're going to build out that portfolio, particularly once you're retired. Before you're retired, we could use these same buckets to fill them up, but they're really a piggy bank instead of a paycheck, which is great. We can take money off the table and have it ready so that when you need to spend it, we still have it available and we're pulling it out of the market. But once you're retired, we have these buckets filled up. We've got, in this case, I'm showing 8 years. And then we've got, it depends on how long your financial plan is, but we've got somewhere, 9 to 30 years. Maybe your plan goes out, 40 years, whatever that horizon is. That's the purpose of the stocks, and the stocks are going to fund those. The immediate cash, that's going to fund this year. Next year's bond, it's going to fund next year. 5 years is going to fund 5 years. 10 years, if we've got 10 years, it's going to fund 10. In this case, 8. That's the last one we have. Well, what happens as a year goes by? Well, we've spent the money out of year zero, and now we have to take the bucket and as those bonds mature, they become the cash that we're going to spend now a year later in year one. And then we have to decide what we're going to do, because now the portfolio went from 8, we had 8 years of bonds. Now we only have 7 because 1 year has matured off. And so now we only have years 2 through 8. So what are we going to do about that? Well, we're going to decide if it's a good year to do that. We're also going to take that bucket of stocks and sell a little bit of it and convert those to bonds that are maturing in year 9, right? So that becomes, now we've extended that portfolio out. We may or may not do that depending on what's going on in the market. If it's a terrible year to sell stocks, we don't need to sell stocks. That's the whole reason we've got 8 years in this case, why we have 8 years sitting in front of those stocks, because we don't have to sell them. We're not forced to. The bonds will mature. They'll give us our liquidity that we need. And as things in the stock market recover, then maybe we have to wait and ride through it. Or maybe it's a great year and it's a great opportunity to, we bought low and now it's our opportunity to sell high, to sell some of those stocks and to extend out that bond portfolio for another year. We're going to track the whole thing with the critical path. I'm not going to go into a whole lot of detail about it here, but I know you guys are familiar with that. The critical path is what Marcel uses to turn your individual financial plan into your own benchmark, right? And it's got all these things that you may be doing. If you're in accumulation, you're sort of pre-retirement, in retirement, no matter where you are in that cycle, we got your critical path. We know where you need to be and what you're trying to do, and we'll invest accordingly and use how you're doing relative to your plan to make the adjustments. And with that, I'm going to hand it over to Professor Huxley and let him take you through some of the more technical stuff of how we think about, particularly on the equity side.
Okay, let me bring mine up here. I hope everyone can see this. I've had a little bit of electrical trouble here, so I hope we don't have a problem. My screen went blank for a minute there, and it scared the daylights out of me. So we're going to be doing talking about the same sort of thing here. One of the questions that I will have is at the very beginning, because I used to teach statistics, is how do you measure turbulence? I taught statistics as a professor at the University of San Francisco for many years, and I had to deal with students wondering, well, how do you what's this stuff all about here? Why do I need all this stuff here? And how do I measure things? Well, one of the first things to understand is that there's a variety of ways to measure things. And when you talk about the term turbulence or volatility, how do you go about actually measuring that? What do you use for that? There's several different ways in which to look at it. Since I taught statistics, of course, I put that on the top line here. You look at the numbers and see what the numbers can tell you under those circumstances. But of course, one of the questions that brings up is, well, which numbers do you use? How far back in time do you go? One of the unanswered questions that theoreticians and statistics have not yet answered is how far back should you go? They have no really good theoretical answer for that, but they say, well, don't go any further back than when you have trustworthy data. So right now, that's about back to 1928, which is about 100 years now. So we've got a pretty good set of data that we can trust, which is a good thing. That was based on a major project at the University of Chicago back in the 1960s, where they finally put together a database that everyone believed was a good one to use here. Another one of the issues that comes up here, besides the starting date and which statistics to use, is what are you looking at daily trading volatility? You're looking at weekly volatility, monthly volatility, annual volatility, quarters. What is the actual measure of that you're going to be looking at turbulence? These are all sort of very fundamental questions, and so we're going to try to cover a few of them here, because the good news is that we get pretty much the same answer no matter which ones we decide to use here. I'm going to start here by scaring everybody with this nasty looking graph here. That's the data going back to that almost 100 years ago, showing what happened every day. And this is the SP 500. We can make equivalent graphs for the other segments of the market, but the SP 500 is probably the most studied set of statistics that we have available for the research that we do when we're trying to make our decision as to how best to implement our strategy here. There's a total of 25,577 trading days. I think this was to the middle of 2025 is when we put this together. So notice that a couple of things that you need to notice here in this presentation or in this chart is that note that before they had government laws on the stock market, you had major volatility. We think it's bad now, but notice how much worse it is here than after they passed those laws. Much lower overall average level of volatility after the laws were passed here. So the government actually did some good things there in terms of how they handled the volatility. So the other thing to notice are these occasionally big blips. This is what you'd call major turbulence. All this little stuff in here is, I suppose, just what you'd call normal turbulence. But you occasionally get these major things. You think Cesar was talking about headlines. These are the things that generate headlines. Boy, the financial reporters love these. They can just make them in big, bold letters here. Oh, look, the market here went down by 20.5% yesterday, blah, blah, blah. So notice that those major shifts here, another thing that's interesting about this is they come in pairs. Notice that this really big guy here, which is the record, I think, for the worst one ever, even going back to 1928, happened in 1987. And that was on October 19th. What happened on the 2 days later? It went back up it recovered almost half of that, right? Here's another one, big one here. And then it was followed, a big drop, followed by a big gain. Big drop, followed by a big gain. Fairly big drop, followed a fairly big gain. So these major shifts of these major movements in the market here that create the turbulence that creates the headlines. The interesting thing to note here is that they come in pairs, which means that if you sold out down in here scared to death, you would have missed this comeback, this immediate comeback. In almost all these cases, the big gains follow the big drops because the overall market grows around 10% per year, but it's never smooth. But the point is that you don't want to let these things force you to miss out on, taking irrational action down in here to miss out on these big gains that are going to recover from the thing there. So that's the purpose of that chart there. Okay. Now I'm going to get really professorial here. This is the normal curve. I imagine some of you have seen this sometime in your past. If you do, you might not want to remember it, because if you didn't like your statistics class, you probably didn't like to do this. But the point is, this is what we statisticians call the normal curve. It's called normal because many things that are observed in the real world follow this normal curve. And back in the late 1700s, they discovered that the samples drawn from any population will follow this normal curve. So it has some theoretical justification. It's not just something that they happen to see often. The trouble is that although a lot of things follow this normal curve, with the most of the stuff happening in the middle here, and then you get these, the further away you go, the fewer that you see. That's what they consider to be normal. Unfortunately, whenever you get these things that are outside of what we would call sort of the normal area inside in here, where most of the things happen, those are outliers, and those deviations in the stock market now are called black swans. Why on earth would they call them black swans? Well, here are some black swans. The origin is from the Middle Ages until I think it was actually I think I got this wrong. I think it's look up another one here. I think it was actually 1697 or something like that, where the English had only ever seen white swans because that's all you could see in Europe, and so they didn't believe that there was any other color than a black swan. As a matter of fact, it was used way back then to as an analogy for things that were impossible. It's what it's a black swan. I mean, it was practically impossible. But they were actually then discovered in Australia way back when, several hundred years ago, and that was considered to be quite a surprise there. And so now that the general term, though, has stuck as being anything that is unusual, extremely unusual, a very rare event, is considered to be a black swan. And there was a fellow by the name of Nassim Taleb who wrote a book. He's written several books on the stock market, and he entitled one of them The Black Swan to try to get the point across that you have to be aware of black swans. In other words, deviations from the normal curve when you're dealing with investments in the stock market. Well, here's our little black swan here. We have the little wings spread out here. We paid a young artist to draw this little picture for us here. Here's the actual distribution of daily stock market changes, the returns in back to 1928. And you can see the normal curve, and then here's the real curve for the SP 500. And it has the same sort of a basic bell shape, but the trouble is you have these little edges out here that are way above what they're supposed to be. In other words, this is 3 standard deviations or more away from what the mean is in the middle here. Well, you should have, if it's a normal curve, you'd have no more than 35 standard deviations for the 25,000 observations that we had here. In fact, we got 216 in the actual record. Well, think about it. That's way 6 or 7 times as many as you should have out there. And these guys out in here on the left-hand side here, these are negative numbers below the mean. If the mean here is the average return, this is way below it. And these are nasty. These are things that you don't want to see. Here, the same idea appears, only this is on the positive end of things. Remember we said things come in pairs? For every one of these guys here, you usually have one of these guys over here. And so in this case, we should have had, if it was nice and symmetric and smooth, like the theoretical normal curve is, you would have 35 on each one of those ends out there. Sometimes we're calling them wings here, but you can call them tails, whatever you want to call them out there. In fact, we've got way too many of the positive ones. And that's, again, because we have this pairing that occurs with regard to the deviations in the returns away from this normal here. So you have this very sharp peak, which is different. Notice over in here also on the sides here, where you would expect to have a larger number of observations that are closer to the mean, you have a very small number. So you could say these are the boring days that the financial reporters don't want to talk about because they're very boring. Oh, it went up. They would not sell too many newspapers or podcasts here if they said, oh, the market did the same thing today as it did yesterday and last week and last month. So that no one would particularly want to listen to that. What they liked hearing about are these deviations, these black swan events that occur way out there. That's what's going on here. Here's this graph again with the daily returns going back to 1928. All these little green ones, I had put those in there, and the red ones down in here to indicate the fact that the black swan events do occur, and they also occur in pairs. I already sort of mentioned that a little bit earlier, but I just wanted to bring that point out that they do happen in pairs under those circumstances. Well, the next issue that comes up here is, does the same thing happen when you're looking at longer spans beside days? Well, the days are here in the upper left-hand corner, but you can see here for the weeks, more black swans. maybe I should have made these all black. I don't know. And here are the months, here are the quarters. Notice that you have fewer data points here because you're dealing with quarters here, but you still have these black swans that do occur, and they occur fairly close together. Same pattern of having coming in pairs, and that's something that you need to remember whenever you read these headlines about how the market has gone way down today. Here we are at randomness in terms of the overall averages here. This is the annual pattern here of the returns here. It's still random, and you still have these black swans occurring. So it's just something to keep in mind that the stock market never moves smoothly. It's always moving up and down, and that's just the nature of the beast. It's like flipping coins. There you have this random pattern that persists. As Cesar was saying earlier, it's the long term that counts here. So you can't be too concerned about what's happening, in the immediate headlines that you're seeing right now under those circumstances. Okay, here's sort of the old long-term average there with the 10% through. You can see it kind of goes up and down as a result of the random patterns here. Okay, the next thing I'm going to talk about here are correlations. I'm going to shut up for a minute here and let you just sort of read through that.
By the way, make sure you sharpen your number 2 pencils because there will be a quiz at the end.
He always teases me on that. All right, so here's the article that I mentioned at the very bottom there. That recency bias is something that psychologists say that most people experience, that it's what happens, they call it recency, or psychologists call it recency bias because it's what happens when people put too much emphasis or too much importance on what happened most recently. So if whenever we read these things, it's natural to feel worried about it. You always wonder, good grief, is something major going to change here? Like, is AI going to change everything? Is Iran going to change everything? Is the next election going to change everything? Well, really, nobody knows because no one is, as Cesar said at the very beginning, no one can predict the future. So maybe things will change, maybe they won't. The one thing we can be sure of, we can predict, is that it will change. Okay, that random pattern there will persist over time. We don't know what the cause will be, but we know that it will happen, at least based upon our experience over the last 100 years. Okay, here's a little thing more on correlation. Here's my professorship coming out here. As Cesar mentioned in a couple of graphs that he had, what statisticians try to do when they're trying to determine whether or not there's any relationship between things, they plot these correlations. Over here on the left-hand side, here's that little diagonal pattern that he mentioned. This is where you have a positive correlation. If we're talking about the stock market daily changes here, does today predict tomorrow? Well, if the little plot of points look like that, then we say, well, yes, it does. There's a positive relationship here. If it went up today, it's likely to go up tomorrow. On the right-hand side, you'll see just the opposite. These are strong negative correlations. If it went up today, it's going to go down tomorrow. Okay, so that's sort of what happens. So the question here becomes, what's going to be the actual correlation there? Well, I've kind of already answered that question. There's the plot of points there. And Cesar had a number of those kinds of points as well, where he showed that the graphs show that there's no particular pattern of these points at all. It appears to be completely random under these circumstances. And that's why you see this idea of there's very low correlation. The actual mathematics here is minus 1.5% correlation. Well, anything below 20% is considered to be very weak or non-existent. Okay, it's just like getting a heads versus tails, and like getting say 51 heads out of 100 flips of the coin. Is that extra one? Is that really significant? Well, no, it isn't. It's just a random chance there. That's what that means. Okay, so how about that one was for daily? Do we see the same thing when it comes to weeks and months and longer spans like that? Well, the answer is yes, we do see the same things. No, we don't see anything different here. We see these random patterns. So the bottom line here is all those correlations are very low. So what it says is that just as today doesn't predict tomorrow, this week doesn't predict next week, this month or next month, or this quarter predicting the next quarter, whether it's going to be up or down, which is probably drives everybody nuts because you'd like everything to be very predictable. Unfortunately, it certainly is not. At least statistically, these little charts here are supposed to demonstrate that idea. We also, when we were doing our research on this business about bias, we looked not only at those very short periods, we also looked at longer periods here. And these, I couldn't put all these graphs on here, but you can see here 1 year to the next year, that also is a very low correlation here. You go out 1 year, how about the next 2 years, 3 years, 4 years, 5 years, 10 years? You can see they're all very low correlations here, all these things. What about the last 2 years and the next 2 years? Last 3 years, the next 3 years. And you can see all these numbers here are all very, very low. As a matter of fact, the largest one here is is a minus 25.6%. Notice something else here is that most of them are negative. Well, you have to wonder why most of them seem to be negative under these circumstances here. Okay, well, the next little graph I think will kind of show you the idea why that's the case. What happens here is that you get this pattern. Here's the long-term average of that 10% that I mentioned earlier. If everything was very, very smooth, you'd have no change. Every year be 10%, every day be the same, every month, week, the whole thing, everything the same. But we all know that that's not the way the world works. But what happens is you get this thing referred to as reversion to the mean here, or reversion to the long-term average here. When things are going really well, they go well for a while, and then boom, they drop back to the normal. Then they'll grow faster again, and they drop down below the average here. Then they stay below the average for a while, and then they started heading back up again, and they're heading back up, and they went way up here. Now, guess what happened? Dropped way back down again. This was what we've seen in the most recent years here. The charts that Cesar had earlier indicate the same thing. So it's understandable that the market just does not grow smoothly. That's just the nature of the beast here. Okay. So what's the bottom line here in terms of trying to get interpret all this stuff? Well, one of the things to understand here, and I guess this is again we're throwing a lot of pot shots here at Wall Street and the financial reporters, but what these little two graphs show, here's 1928 up to 25. This is daily changes on average. Again, over this span of time, on a daily basis, they changed half the time they were positive, or 53% of the time they were positive. Here it is for weekly, monthly, quarterly, and 1 year. Notice that these numbers are all getting slightly larger each time. Well, these are the kind of things that generate the headlines, and that's where Wall Street likes to play, that in that area in there, and try to convince you that, oh, these things all mean something. This getting ahead this week means that something that you're either going to get ahead or tail next week, depending on how they want to spin it. Okay. The best way to think about the market is to invest in the long term. Notice when we get up to this 10, 11, 12, up to 30 years here, look at those probabilities that you're going to have a positive return. This is where investors ought to be. Individual investors ought to be way up in here. So you should always be thinking long term, not short term, unless you like to gamble. I mean, if you like to gamble, good luck. But there you are down in there. But when you get up to the longer term, if you're investing for the long run, you have much greater odds that are in your favor. But that was for the last 100 years. What about for the most recent 30 years? Well, look at the numbers. They don't really change much. When people say, oh, it's going to be different now, well, all I can say is that historically speaking, the actual percentages here have not really changed very much. If you compare them here, you can see these numbers are all about the same. Okay. And the same thing is true for the long term here, the 10, 15, up to 30 years here. Those numbers are all very favorable numbers. And so that's where all the data says, stick to the long term if you want to, maximize your probability of having a successful investment pattern here. That's what the bottom line says here. It says invest for the long term and ignore the turbulence. Then I had one more slide here. I think I had one more slide. Let's see here. Oh yeah, this is asset dedication. This is sort of bragging in the terms of how many, what our record has been in the long term here. Again, using the long term back to 1928 period here, our goal, the way that we build our portfolios is we try to maximize the minimum return over whatever targeted time horizon that seems best to you based upon what Marcel has determined after her time with you. And note that it depends upon which particular time horizon you're talking about, but they all beat the Standard & Poor's 500. Its long-term average is about 10.2%. The our worst one here is the very short-term portfolios that we build for people who have a very short-term perspective here. It's only 9.3%.
Which nobody uses.
Nobody uses it. Yeah, nobody.
It's not really designed for people.
I
The
think
rest
we
are
had
designed
one.
for people.
Yeah, well, I think we had one lady once that she passed away, and that's, she had a short-term horizon. I can't remember. Anyway, and we have to put all this business in here. The government requires us to put this information in here. All
And that's
right,
a
so
great opportunity to transition to, thank you, Steve, Brent, and
yep,
Cesar. First of all, I want to emphasize that this webinar is all educational, and we only have about 5 minutes left. So I'm not really going to go into my presentation. I just want to say that the role of TQM Wealth Partners is to bring all of this together. And the behavioral advantages of planning are that we are not only looking at the at testing portfolios, but also testing investor behavior. So why does TQM Wealth Partners work with asset dedication and dimensional funds? Because as fiduciaries, it's really important for us to provide to our clients intellectual rigor and evidence-based returns. And I think the presentations have spoken for themselves. But the question is then, how do you apply this to your personal life? And that's what the financial plan does. First of all, in order to build the asset dedication strategy, you need to know when you need your cash, short-term, mid-term, long-term. The financial plan articulates those things based on your personal values, your goals, and your legacy plans. And though markets are always going to be uncertain, as Steve was pointing out through the graphs, at least historically, what they've proven is that for the long term, they pay investors for taking risk. But what you can have certainty around is your financial plan, because the relationship between your goals, time horizon, and portfolio structure can remain stable and knowable even during those times of uncertainty. So in the last 2 minutes that we have left, I do want to ask if people have questions. We did have a question come in before the webinar started, and actually, we have a comment from one of our team members that says you cannot do the long-term investing without understanding your short-term cash needs. And that's very true. And one of the perils of not planning is using long-term capital for short-term needs. And so I could, talk for another hour about the importance of planning. But we really wanted to highlight investing with confidence in turbulent times. I want to highlight how the plan provides clarity, and clarity is what gives you and us, with our clients, the ability to create the structure you need, and the structure is what gives you confidence. I do want to read the question that we got before the webinar started. It says, what would have to happen or has already happened to conclude that the current markets are not just volatile, but fundamentally misplaced from a risk standpoint? For example, it's difficult to ignore the promise of AI. Will it lead to more productivity across all sectors? If so, how will that productivity be monetized? Will it widen moats and increase margins, or reduce costs and lower both product and service pricing? And, I put those questions out to Cesar and Brent, but obviously,
I'll jump on that one.
Professor.
Oh, let me jump on that one, because I'll say my oldest son went to University of California at Berkeley, just graduated last year, and his degree was in AI. And so I spent a lot of time talking with him, working with his capstone project. We actually built financial planning software using AI. And people say, well, AI is different now, which makes it all different now. It's like, well, so did the internet, so did the telephone, So did the telegraph, right? So did the printing press. So all of these things, the computer, right? The personal computer, um, they all have moved us forward, and there will be industries that get left behind, right? When you look at what the Dow Jones Industrial Average was made up of at the turn of the 19th century, so between the 19th and 20th century, when it first started, it was sugar refineries, it was rubber manufacturers, and petroleum, right? Those were the big companies, right? There were companies that made wagon wheels and buggy whips. Not a big industry anymore, right? Sugar's not a big deal anymore. It was then, right? All of these things they just change over time, and I will say that new ideas grow faster than old tired ideas die out, right? So Google grows faster than Kodak dies. Kodak's still a company that's out there, but it's been dying for the last 25 years, right? But at one point, it was the 7th largest company in the world. It is no longer even in the S&P 500. But it, sort of trails off as that industry matures and new industries come in and just sort of supplant the old ones. And so I would say I'm not worried about AI in terms of it fundamentally changing economics, because it just won't, right? Supply and demand is always going to be supply and demand. And so will it make people be able to do things faster? And is there probably going to be a bubble based off of? Yeah, probably. Are we going to see, valuations that are crazy? Probably, but it'll eventually settle out and we'll figure out how to use it in a very productive way.
Thank you very much, Brent. That's a great reply. And I'll just close by saying the whole point of having a team like TQM Wealth Partners, Asset Dedication, and Dimensional Funds working together, which, by the way, we do not share revenues, or, we are separate entities that collaborate. And but the importance and the value of that is to take strategy and bring it to life and to apply it to your individual lives, because the plans are your decision-making tools. They're living, breathing documents that tell you where your risks are, which may not even be your portfolio. As our clients know, sometimes the biggest risk is the morbidity event, like a disability or a long-term care event. So going beyond investments in financial planning is extremely important, and making it comprehensive with intentionality, understanding what you individually are trying to accomplish, which is exactly what the media has no idea what its millions of viewers or readers or listeners are trying to accomplish, what they need. To Brent's point, they have no fiduciary obligation. We do. And as fiduciaries, the plan is the best indicator for how your portfolios should be structured. And it also tells us, in terms of the growth portfolio, especially, what evidence-based results we're going to look for, instead of trying to have a crystal ball, which doesn't exist, to guess what would constitute a growth in the future, based on opinions that, as Cesar showed at the beginning, tend to be wrong. So with that, I want to say thank you to our panelists, Cesar, Steve, and Brent. And maybe our next webinar will be all about financial planning, because we did run out of time. But it was important to address this from the investor or investment point of view. So thank you, everybody, for joining us, and we'll see you next time.